Today, June 19th, U.S. markets are closed for a federal holiday. Over the last day, global financial markets have been rattled by a sharp rise in risk aversion, and the main reason is the sudden escalation of direct military conflict between Israel and Iran. This has sent shockwaves through the financial system, with oil prices jumping and investors rushing into traditional safe haven assets like the United States dollar and gold. All of this is happening against a backdrop of growing differences in how the world's major central banks are handling interest rates and inflation. The United States Central Bank is holding rates steady and signaling a long, patient fight against inflation, while central banks in Europe and Switzerland have started to lower rates. United States stock markets have shown some resilience, especially in technology stocks, but European and Asian markets have been hit much harder by the risk-off mood. Meanwhile, there are signs of stress in the United States government bond market, with a weak auction for 20-year bonds suggesting that the government may face higher borrowing costs in the future, regardless of what the central bank does. The most important story driving markets right now is the direct military confrontation between Israel and Iran. In just the past 24 hours, Israel launched a wave of airstrikes on Iranian nuclear sites, and Iran responded with missile attacks near Tel Aviv, hitting a hospital and several residential buildings. This is a major escalation, moving beyond the usual proxy conflicts and raising the risk of a much wider regional war. The situation is made even more volatile by mixed signals from the United States government. The president has at times called for Iran's unconditional surrender, which sent oil prices soaring, but has also said he's not looking for a fight. Reports suggest that attack plans have been approved but not yet ordered, leaving markets on edge and adding to the uncertainty. The most immediate and dramatic impact has been on oil prices. Both major oil benchmarks have surged, with prices now reflecting a significant risk premium. The market is worried about possible disruptions to oil supplies, especially through the Strait of Hormuz, which is a critical route for global oil shipments. Tanker rates for passing through the region have doubled as ship owners avoid the conflict zone, and these higher costs will eventually be passed on to consumers. At the same time, gold prices have climbed as investors look for safety, and the United States dollar has strengthened, benefiting from both its safe haven status and the central bank's tough stance on inflation. On the international stage, leaders are scrambling to respond. France has called for a European-led diplomatic effort to resolve the crisis, but recent summits have produced little progress. The United States has ordered non-essential personnel to leave the region, signaling a heightened state of alert. Despite the spike in oil prices, there has not yet been an actual supply disruption. Oil is still flowing through the Strait of Hormuz. Recent data shows a large draw in crude oil inventories, but a surprise increase in gasoline stocks, which suggests that consumer demand may be weakening. This means that the current high oil prices are being driven more by fear and uncertainty than by actual shortages, and any sign of de-escalation could quickly reverse the price surge. All of this is happening as central banks around the world are moving in different directions. The United States Central Bank kept rates steady and signaled caution, with officials saying they are in no hurry to cut rates and will remain data-dependent. Their latest forecasts point to slower economic growth, higher inflation, and higher unemployment, suggesting a more challenging outlook. In contrast, the European Central Bank has started to cut rates, saying inflation is on track to fall back to target levels. However, they are not promising a rapid series of cuts and are taking a meeting-by-meeting approach. The Bank of England is also divided, with some members pushing for a rate cut due to signs of a weakening labor market and moderating wage growth, while others want to hold steady because of persistent inflation and rising energy prices. Other major central banks, including those in Japan, Canada, Australia, and Switzerland, are also leaning toward or actively cutting rates, creating a dovish bloc that stands in contrast to the United States' more cautious approach. This divergence is making the United States dollar more attractive, especially as investors seek safety amid the Middle East conflict. Stock markets have responded differently across regions. In the United States, markets were mostly flat, with technology stocks showing strength as investors look for quality and growth. There's a clear rotation into sectors seen as safer, like utilities and real estate, and away from more economically sensitive areas. In Europe, markets fell broadly, weighed down by both the Middle East conflict and concerns about possible United States tariffs on European goods. Asian markets were hit hardest, with Hong Kong and Japan seeing sharp declines, reflecting their sensitivity to disruptions in global trade and energy flows. The United States government bond market has also been in focus. Yields on longer-term bonds have fallen more than those on shorter-term bonds, as investors seek safety and worry about future economic growth. However, a recent auction for 20-year bonds was weak, with low demand and higher yields, suggesting that investors are wary of holding longer-term United States debt. This could force the government to pay higher interest rates in the future, raising borrowing costs across the economy. At the same time, the central bank is reducing its holdings of government bonds, removing a key source of demand. If the government cannot find enough buyers for its debt, it may have to offer even higher yields, which could slow economic growth and hurt stock valuations. Despite the geopolitical turmoil, the core infrastructure of the financial system appears to be functioning smoothly. Key liquidity facilities are operating normally, short-term interest rates are stable, and there are no signs of unusual stress in money markets. Money supply is growing modestly, and flows into and out of money market funds are within normal ranges. In the options market, there has been a surge in activity as investors hedge against volatility and make targeted bets on individual stocks. The market's main volatility index has spiked, reflecting broad market fear. There's been especially heavy trading in options tied to oil prices and technology stocks, with traders divided on the direction of future moves but agreeing that big swings are likely. On the corporate front, recent regulatory filings from major companies have been routine, with no major surprises or market-moving news. In Washington, the political environment is dominated by the Middle East conflict and its impact on domestic policy. There is division within the government over how to respond, with some lawmakers pushing for restraint and others advocating a tougher stance. Meanwhile, new tariff policies are projected to reduce the federal deficit, but also raise inflation and slow economic growth, creating a dilemma for policymakers. In summary, markets are on high alert, caught between the fear of a wider Middle East conflict and a complex global economic backdrop. The main short-term driver is the risk of further escalation, which is pushing oil, gold, and the United States dollar higher, while global stocks, especially outside the United States, are under pressure. The divide among central banks is making the United States dollar even more attractive. However, the weak demand for long-term United States government bonds is a warning sign that could lead to higher borrowing costs and economic headwinds. Looking ahead, the market's direction in the next few days will depend almost entirely on developments in the Middle East. If the conflict escalates, expect another jump in oil prices, more volatility, and further declines in global stocks. If the situation remains tense but stable, markets may trade sideways, with continued focus on central bank policy and economic data. If there is a credible move toward de-escalation, the war premium in oil and other assets could quickly unwind, leading to a relief rally in stocks and a drop in volatility. For investors, the current environment favors holding the United States dollar against commodity-linked currencies, being cautious with long-term government bonds, and considering strategies that benefit from volatility in select stocks, especially in the technology and energy sectors. The key is to stay nimble and closely monitor developments, as the situation remains highly fluid and unpredictable. Visit the dashboard below. Like, comment, follow, and as always, thank you.